Okay, we'll start with a question on everyone's mind in general. How is the hospitality industry faring as we all emerge from the pandemic? Want to go first, Dupree?
Sure, I'll go first. It has sucked. That's a technical term. It has been, the past 2 years has not been great, but we are seeing light at the end of the tunnel, I think just in time for a recession. So I'm not sure what'll happen, but we are seeing some improvement on the transient side, business travel. We are seeing a lot of group business start to come back. But I do think we're going to see some softening here in the next year or so, which when we had this prep call, we probably weren't as confident about what was coming. Now I think we have a little more visibility into that. So, but I think, look, it has been interesting because, you know, anytime you have a crisis, right, it forces you to think differently. And our team has certainly done that, where we have kind of gotten into the hotels and really, even in some ways, helped our operators think about how to operate these hotels in a different way. And a lot of those lessons that were learned and cost-cutting measures will be permanent, some of which travelers aren't going to necessarily want or appreciate. But as you guys have seen, what you're paying for hotel rooms is going way up. And sometimes the value, actually what you're getting in the product, is not necessarily commensurate with that. And so that's at least a trend that we've seen historically happen in hotels, where pricing for hotels has outpaced inflation. And so that for us, that is actually a positive of our industry. We can hedge literally by the hour, when in other forms of real estate, industrial or office or other things, you don't have that ability. You're locked into a lease. So there are some benefits to that. What do you guys think?
Yeah, I agree. You know, it's interesting. When I'm asked this question, I always ask, well, do you want me to look back or do you want me to look forward? Because depending on the direction I'm facing will dictate the answer. I mean, look, from a backward-looking perspective, Dupree is right. I mean, the operating fundamentals over the past couple years, going back to the start of COVID, have been challenged. 2021 and 2022 have been good recovery years, such that from a RevPAR basis, we are actually back up to beyond where we were in 2019, which is the benchmark that most hoteliers use to determine how operating performance is. So we're up about 5% on a RevPAR basis compared to 2019. From a transaction volume perspective, which has been interesting, I mean, last year, 2021, was the second largest transaction volume year in hospitality. Wow. 2015 was the largest. I think 2015 was about 48 billion. Last year was about 40 billion. This is domestic in the U.S. I think generally 25 million or larger. This year, through the end of July, we're at about 23 billion, which for that time period is the highest it's ever been. That's up about 86% compared to 2019, just in terms of transaction volume. So a lot of trades happening, a couple large portfolio deals that have gotten done. There's another large portfolio deal that's been announced and approved that'll close in October. And actually, interestingly, there have been a record number of single asset or just individual trades. Yeah. So there have been about 715 individual trades through the end of July. So busy year, again, in the rearview mirror, looking forward for a lot of the reasons Dupree mentioned, in addition to what's going on with the Fed and interest rates. Transaction volume has started to slow over the past couple months. We're still seeing strong operating performance, but the expectation is that as we potentially move toward a recession, we'll see declining operating performance. But right now it's interesting. It's a tale of two worlds, because operating performance is generally very strong, but the capital market's very challenged. So when hoteliers say, I want to go out and sell, or I want to go out and finance, my asset's doing incredibly well, you look at the capital markets and you're sort of caught up in the macro situation with higher rates and concerns about inflation. So it's a little bit of bifurcation there. But again, it should be a very interesting next 6 to 12 months as we move into sort of a higher rate environment.
Yeah, the only thing I'd add is, you know, Dupree, I understand it sucked in 2020, but to Kevin's point, 21 and 22 were actually pretty darn good years for the hotel business. And I'm actually much more optimistic. I mean, I can't see a scenario where we go back into what the hotel industry went through in 2020 with global travel completely stopping. And the fundamentals are pretty phenomenal, especially in some of your leisure assets, and even picking up in urban cores with like New York, right? We were there
Yeah.
a couple of weeks ago. New York is back. It's after Labor Day, corporate's back, people are back in the office, group is back. The social events, Fashion Week was going on last week. It was, unbelievable. So I think that the other great thing about the hospitality business is we've got more liquidity and more people trying to get into hospitality today than we've ever had. So from a liquidity standpoint, equity, lenders, we actually, I think we have some runway if we don't, go into a deep recession. But right now we do have a pricing problem as far as debt is just really expensive.
Yeah.
Mispriced.
Mispriced.
Yeah,
Mispriced.
I agree. Expensive and mispriced.
Let's follow up on your comments about transaction volume. So what's driving it? Like, how would you describe the buyers and the sellers? What types of properties are getting the most attention, and how would you describe it? Who's looking to sell, who's looking to buy?
Yeah, it's a great question. Look, I think heretofore there's been a strong bias towards drive to leisure resort assets. Those were the first assets to recover post-COVID. You had, coming out of the pandemic, there's revenge travel. People want to get out. They want a social distance. So beach destinations, resort destinations, places where people could social distance were the first to recover. And on the strength of that strong recovery, we've seen investors gravitate to that product because it feels like there's some downside protection. I'd say over the past 9 to 12 months, we've started to see a recovery of urban assets. So if you look at the top 25 hotel markets, generally the big cities, they fared incredibly poorly during COVID. I mean, most are in blue cities, a lot of union. International travel is a big driver for a lot of those places, and that fell off. So those assets really struggled. So I'd say over the last 9 to 12 months, we've seen a recovery in urban, more investors starting to look at markets like New York and Chicago, Boston. San Francisco is a real laggard, but some of the big cities people are starting to look at. So I think the other part of your question was the reason why. Look, I don't think we've never had a recession within hospitality of the magnitude that we just experienced, and so I think investors have been attracted to the space because of the recovery that we're experiencing, but also to the point that Dupree made earlier, which is it's a phenomenal inflation hedge. So even while multifamily industrial, which was priced to perfection, as soon as rates started to move, you started to see pricing be affected to the negative in those asset classes, not necessarily in hospitality. I mean, over the course of a closing period, you may have a buyer go exclusive on a deal, 60, 90 days later, NOI may be up 5 or 10%. And so that'll offset the rising cost of debt. So I think the inflation hedge reason is another reason why people have been attracted to the space.
The other thing on that point is hotels have always priced at a unusually wide margin above the other indices in the risk-free rate. So we've got a little more cushion for some of this spread gapping out. But again, it's in our view, it's have and have nots. There are markets that are very liquid and assets that are very liquid, and then there's markets that are really, really tough. I mean, Chicago right now is next to impossible, even if you've got a really strong performing asset, of which there's only a couple. It's tough to get, for a variety of reasons, it's tough to get institutional capital to go there. Too many people have lost too much money there. But Kevin's point is on, like leisure is still on everybody's radar. The only thing better than drive to leisure is private jet to leisure, because that is absolutely recession proof. And so when you're working on assets like Montage Laguna Beach and Four Seasons Jackson, those they're at all-time record profitability, and they're not slowing down.